going to be the facilitator for the recent County Library Seminar. This morning, we're going to be doing lesson 7. And as you remember, back on lesson number 1 or 2, we started talking about people's salaries and the discrepancy that we have in salaries in the United States, where 90% of the working family make around $30,000 a year. And then there is 1/100 of 1% that they make $1.2 million an hour, $500,000 an hour, and so on. There's about 15 families that can do that in this country. However, we're going to talk today about the number 2 man on the census of 2008. He's a wonderful person. If you see him on the street, if you see him on an interview, you just don't think that this man is a person, because he's not a bragger. He don't talk about anything like that. He's a very simple person, and that he can make $1.2 million an hour. So on lesson 7, we're going to be interviewing Mr. Ray Dalio. So I'm going to ask you to listen to his answer. He's going to be interviewed by 2 different things, and the commentary that he had to make about how the economy works. We should learn from that. And then he's going to have an interview where they ask him different questions about the economy and so on. And I'm very sure that we all can benefit from what Mr. Ray Dalio has to say about the economy, how the economy works, and he just simplify in a way that is easy to understand for anybody. So with that, I want to thank you for your time, and please, 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 please listen carefully to what Mr. Dalio has to say, because we're dealing with a man that makes $1.2 million an hour. We can learn something from a person like that. So with that, we're going to start lesson number 7, sorry, lesson 7, and let's see what Mr. Dalio has to say about markets, economy, and so on. So thank you for your time, and we'll see you on the other side. We're interviewing Mr. Ray Dalio. Thank you. And as you all know, this is the online investment seminar. We're getting close to the end. This is going to be lesson 7. As I mentioned before, lesson 7 is about an interview and what Mr. Ray Dalio had to say about the economy. We're going to go over this right quick so we can start the seminar. So here we go. It's an online seminar. We're going to be discussing it online due to the pandemic. So welcome, class, and let's go over the material that we're going to do this morning. As you all know, on lesson 1, or lesson 2, I think, we went to and saw different salaries and the discrepancy between salaries and where 90% of the working families in the country, they make less than $30,000 a year on the average. We talk about Oprah Winfrey making $65,000 an hour. Over here, we're going to view right quick some of this here. As you can tell right here, like the guy from DirecTV, he made $15,000 an hour. Okay. We're going to view over here top high-paid lawyers, the $19,000 an hour. And this is the top 10 for the 2009. Bankers and insurance. The guy from Goldman Sachs, he retired now, but he used to make $6,000 an hour. But the real money makers are hedge funds managers. In 2010, hedge fund managers, Mr. John Paulson made over $2 million $355,000 an hour. Ray Dalio, that is the person that we're going to discuss today. We don't want to discuss all of them. We're going to pick one, so we're going to pick number two. Mr. Ray Dalio made 1.4 million. Some other say that he made about $1.5 million an hour. He's a hedge fund manager that he runs. Mr. Ray Dalio seems to be a very simple person. And what we're going to cover with him is you're going to have the first part of the video going to be on this seminar this morning going to be about how he described the economy. I'm going to ask you to listen to him and understand what he's talking about, because we must respect somebody that made $1.5 million an hour. We can learn a lot with these people. You have heard, you hang around with losers, you become a loser. We hang around with rich people, we become wealthy too. We learn from them. So therefore, let's move into our seminar and see what Mr. Ray Dalio had to say, how the economy works. And then we move into the interview that he talked about what's happening with this pandemic that is taking place right now. So with that, let's roll over to Mr. Ray Dalio interview and how he thinks the economy works. Thank you, and we see you on the other side.
How the economic machine works in 30 minutes. The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works, and this has led to a lot of needless economic suffering. I feel a deep sense of responsibility to share my simple but practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years. Let's begin. Though the economy might seem complex, it works in a simple, mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are above all else driven by human nature, and they create three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We'll look at these three forces and how laying them on top of each other creates a good template for tracking economic movements and figuring out what's happening now. Let's start with the simplest part of the economy, transactions. An economy is simply the sum of the transactions that make it up, and a transaction is a very simple thing. You make transactions all the time. Every time you buy something, you create a transaction. Each transaction consists of a buyer exchanging money or credit with a seller for goods, services, or financial assets. Credit spends just like money, so adding together the money spent and the amount of credit spent, you can know the total spending. The total amount of spending drives the economy. If you divide the amount spent by the quantity sold, you get the price. And that's it. That's a transaction. It's the building block of the economic machine. All cycles and all forces in an economy are driven by transactions. So, if we can understand transactions, we can understand the whole economy. A market consists of all the buyers and all the sellers making transactions for the same thing. For example, there is a wheat market, a car market, a stock market, and markets for millions of things. An economy consists of all of the transactions in all of its markets. If you add up the total spending and the total quantity sold in all of the markets, you have everything you need to know to understand the economy. It's just that simple. People, businesses, banks, and governments all engage in transactions the way I just described, exchanging money and credit for goods, services, and financial assets. The biggest buyer and seller is the government, which consists of two important parts: a central government that collects taxes and spends money, and a central bank which is different from other buyers and sellers because it controls the amount of money and credit in the economy. It does this by influencing interest rates and printing new money. For these reasons, as we'll see, the central bank is an important player in the flow of credit. I want you to pay attention to credit. Credit is the most important part of the economy and probably the least understood. It's the most important part because it's the biggest and most volatile part. Just like buyers and sellers go to the market to make transactions, so do lenders and borrowers. Lenders usually want to make their money into more money, and borrowers usually want to buy something they can't afford, like a house or a car, or they want to invest in something like starting a business. Credit can help both lenders and borrowers get what they want. Borrowers promise to repay the amount they borrow, called principal, plus an additional amount called interest. When interest rates are high, there is less borrowing because it's expensive. When interest rates are low, borrowing increases because it's cheaper. When borrowers promise to repay and lenders believe them, credit is created. Any two people can agree to create credit out of thin air. That seems simple enough, but credit is tricky because it has different names. As soon as credit is created, it immediately turns into debt. Debt is both an asset to the lender and a liability to the borrower. In the future, when the borrower repays the loan plus interest, the asset and the liability disappear and the transaction is settled. So why is credit so important? Because when a borrower receives credit, he is able to increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, and every dollar you earn, someone else has spent. So when you spend more, someone else earns more. When someone's income rises, it makes lenders more willing to lend him money because now he's more worthy of credit. A credit-worthy borrower has two things: the ability to repay and collateral. Having a lot of income in relation to his debt gives him the ability to repay. In the event that he can't repay, he has valuable assets to use as collateral that can be sold. This makes lenders feel comfortable lending him money. So increased income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why we have cycles. In a transaction, you have to give something in order to get something, and how much you get depends on how much you produce. Over time, we learn, and that accumulated knowledge raises our living standards. We call this productivity growth. Those who are inventive and hardworking raise their productivity and their living standards faster than those who are complacent and lazy. But that isn't necessarily true over the short run. Productivity matters most in the long run, but credit matters most in the short run. This is because productivity growth doesn't fluctuate much, so it's not a big driver of economic swings. Debt is, because it allows us to consume more than we produce when we acquire it, and it forces us to consume less than we produce when we have to pay it back. Debt swings occur in two big cycles. One takes about 5 to 8 years, and the other takes about 75 to 100 years. While most people feel the swings, they typically don't see them as cycles because they see them too up close, day by day, week by week. In this chapter, we're going to step back and look at these three big forces and how they interact to make up our experiences. As mentioned, swings around the line are not due to how much innovation or hard work there is. They're primarily due to how much credit there is. Let's for a second imagine an economy without credit. In this economy, the only way I can increase my spending is to increase my income, which requires me to be more productive and do more work. Increased productivity is the only way for growth. Since my spending is another person's income, The economy grows every time I or anyone else is more productive. If we follow the transactions and play this out, we see a progression like the productivity growth line. But because we borrow, we have cycles. This isn't due to any laws or regulations, it's due to human nature and the way that credit works. Think of borrowing as simply a way of pulling spending forward. In order to buy something you can't afford, you need to spend more than you make. To do this, you essentially need to borrow from your future self. In doing so, you create a time in the future that you need to spend less than you make in order to pay it back. It very quickly resembles a cycle. Basically, anytime you borrow, you create a cycle. This is as true for an individual as it is for the economy. This is why understanding credit is so important, because it sets into motion a mechanical, predictable series of events that will happen in the future. This makes credit different from money. Money is what you settle transactions with. When you buy a beer from a bartender with cash, the transaction is settled immediately. But when you buy a beer with credit, it's like starting a bar tab. You're saying you promise to pay in the future. Together, you and the bartender create an asset and a liability. You just created credit out of thin air. It's not until you pay the bar tab later that the asset and the liability disappear, the debt goes away, and the transaction is settled. The reality is that most of what people call money is actually credit. The total amount of credit in the United States is about $50 trillion, and the total amount of money is only about $3 trillion. Remember, in an economy without credit, the only way to increase your spending is to produce more. But in an economy with credit, you can also increase your spending by borrowing. As a result, an economy with credit has more spending and allows incomes to rise faster than productivity over the short run, but not over the long run. Now, don't get me wrong. Credit isn't necessarily something bad that just causes cycles. It's bad when it finances overconsumption that can't be paid back. However, it's good when it efficiently allocates resources and produces income so you can pay back the debt. For example, if you borrow money to buy a big TV, it doesn't generate income for you to pay back the debt. But if you borrow money to, say, buy a tractor, and that tractor lets you harvest more crops and earn more money, then you can pay back your debt and improve your living standards. In an economy with credit, we can follow the transactions and see how credit creates growth. Let me give you an example. Suppose you earn $100,000 a year and have no debt. You are creditworthy enough to borrow $10,000, say on a credit card. So you can spend $110,000 even though you only earn $100,000. Since your spending is another person's income, someone is earning $110,000. The person earning $110,000 with no debt can borrow $11,000, so he can spend $121,000, even though he has only earned $110,000. His spending is another person's income, and by following the transactions, we can begin to see how this process works in a self-reinforcing pattern. But remember, borrowing creates cycles, and if the cycle goes up, it eventually needs to come down. This leads us into the short-term debt cycle. As economic activity increases, we see an expansion, the first phase of the short-term debt cycle. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by credit, which can be created instantly out of thin air. When the amount of spending and incomes grow faster than the production of goods, prices rise. When prices rise, we call this inflation. The central bank doesn't want too much inflation because it causes problems. Seeing prices rise, it raises interest rates. With higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend. So spending slows. And since one person's spending is another person's income, incomes drop. and so on and so forth. When people spend less, prices go down. We call this deflation. Economic activity decreases, and we have a recession. If the recession becomes too severe and inflation is no longer a problem, the central bank will lower interest rates to cause everything to pick up again. With low interest rates, debt repayments are reduced and borrowing and spending pick up, and we see another expansion. As you can see, the economy works like a machine. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? Because people push it. They have an inclination to borrow and spend more instead of paying back debt. It's human nature. Because of this, over long periods of time, debts rise faster than incomes, creating the long-term debt cycle. Despite people becoming more indebted, lenders even more freely extend credit. Why? Because everyone thinks things are going great. People are just focused on what's been happening lately. And what's been happening lately? Incomes have been rising. Asset values are going up. The stock market roars. It's a boom. It pays to buy goods, services, and financial assets with borrowed money. When people do a lot of that, we call it a bubble. So even though debts have been growing, incomes have been growing nearly as fast to offset them. Let's call the ratio of debt to income the debt burden. So long as incomes continue to rise, the debt burden stays manageable. At the same time, asset values soar. People borrow huge amounts of money to buy assets as investments, causing their prices to rise even higher. People feel wealthy. So even with the accumulation of lots of debt, rising incomes and asset values help borrowers remain creditworthy for a long time. But this obviously cannot continue forever. And it doesn't. Over decades, debt burdens slowly increase, creating larger and larger debt repayments. At some point, debt repayments start growing faster than incomes, forcing people to cut back on their spending. And since one person's spending is another person's income, incomes begin to go down, which makes people less creditworthy, causing borrowing to go down. Debt repayments continue to rise, which makes spending drop even further. And the cycle reverses itself. This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer creditworthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments. Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy. People feel poor. Credit rapidly disappears. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%, so the stimulation ends. Interest rates in the United States hit 0% during the deleveraging of the 1930s and again in 2008. The difference between a recession and a deleveraging is that in a deleveraging, borrowers' debt burdens have simply gotten too big and can't be relieved by lowering interest rates. Lenders realize that debts have become too large to ever be fully paid back. Borrowers have lost their ability to repay and their collateral has lost value. They feel crippled by the debt. They don't even want more. Lenders stop lending, borrowers stop borrowing. Think of the economy as being not creditworthy, just like an individual. So what do you do about a deleveraging? The problem is debt burdens are too high and they must come down. There are 4 ways this can happen. 1. People, businesses, and governments cut their spending. 2. Debts are reduced through defaults and restructurings. 3. Wealth is redistributed from the haves to the have-nots. And finally, 4, the central bank prints new money. These 4 ways have happened in every deleveraging in modern history. Usually, spending is cut first. As we just saw, people, businesses, and even governments tighten their belts and cut their spending so that they can pay down their debt. This is often referred to as austerity. When borrowers stop taking on new debts and start paying down old debts, you might expect the debt burden to decrease. But the opposite happens. Because spending is cut, and one man's spending is another man's income, it causes incomes to fall. They fall faster than debts are repaid, and the debt burden actually gets worse. As we've seen, this cut in spending is deflationary and painful. Businesses are forced to cut costs, which means less jobs and higher unemployment. This leads to the next step. Debts must be reduced. Many borrowers find themselves unable to repay their loans, and a borrower's debts are a lender's assets. When a borrower doesn't repay the bank, people get nervous that the bank won't be able to repay them, so they rush to withdraw their money from the bank. Banks get squeezed, and people, businesses, and banks default on their debts. This severe economic contraction is a depression. A big part of a depression is people discovering much of what they thought was their wealth isn't really there. Let's go back to the bar. When you bought a beer and put it on a bar tab, you promised to repay the bartender. Your promise became an asset of the bartender. But if you break your promise, if you don't pay him back and essentially default on your bar tab, then the asset he has isn't really worth anything. It has basically disappeared. Many lenders don't want their assets to disappear and agree to debt restructuring. Debt restructuring means lenders get paid back less, or get paid back over a longer time frame, or at a lower interest rate than was first agreed. Somehow, a contract is broken in a way that reduces debt. Lenders would rather have a little of something than all of nothing. Even though debt disappears, debt restructuring causes income and asset values to disappear faster, so the debt burden continues to get worse. Like cutting spending, debt reduction is also painful and deflationary. All of this impacts the central government because lower incomes and less employment means the government collects fewer taxes. At the same time, it needs to increase its spending because unemployment has risen. Many of the unemployed have inadequate savings and need financial support from the government. Additionally, governments create stimulus plans and increase their spending to make up for the decrease in the economy. Governments' budget deficits explode in a deleveraging because they spend more than they earn in taxes. This is what's happening when you hear about the budget deficit on the news. To fund their deficits, governments need to either raise taxes or borrow money. But with incomes falling and so many unemployed, who is the money going to come from? The rich. Since governments need more money and since wealth is heavily concentrated in the hands of a small percentage of the people, governments naturally raise taxes on the wealthy, which facilitates a redistribution of wealth in the economy from the haves to the have-nots. The have-nots who are suffering begin to resent the wealthy haves. The wealthy haves, being squeezed by the weak economy, falling asset prices, and higher taxes, begin to resent the have-nots. If the depression continues, social disorder can break out. Not only do tensions rise within countries, they can rise between countries, especially debtor and creditor countries. This situation can lead to political change that can sometimes be extreme. In the 1930s, this led to Hitler coming to power, war in Europe, and depression in the United States. Pressure to do something to end the depression increases. Remember, most of what people thought was money was actually credit. So when credit disappears, people don't have enough money. People are desperate for money, and you remember who can print money? The central bank can. Having already lowered its interest rates to nearly zero, it's forced to print money. Unlike cutting spending, debt reduction, and wealth redistribution, printing money is inflationary and stimulative. Inevitably, the central bank prints new money out of thin air and uses it to buy financial assets and government bonds. It happened in the United States during the Great Depression, and again in 2008 when the United States Central Bank, the Federal Reserve, printed over $2 trillion. Other central banks around the world that could printed a lot of money too. By buying financial assets with this money, it helps drive up asset prices, which makes people more creditworthy. However, this only helps those who own financial assets. You see, the central bank can print money, but it can only buy financial assets. The central government, on the other hand, can buy goods and services and put money in the hands of the people, but it can't print money. So in order to stimulate the economy, the two must cooperate. By buying government bonds, the central bank essentially lends money to the government, allowing it to run a deficit and increase spending on goods and services through its stimulus programs and unemployment benefits. This increases people's income as well as the government's debt. However, it will lower the economy's total debt burden. This is a very risky time. Policymakers need to balance the four ways that debt burdens come down. The deflationary ways need to balance with the inflationary ways in order to maintain stability. If balanced correctly, there can be a beautiful deleveraging. You see, a deleveraging can be ugly or it can be beautiful. How can a deleveraging be beautiful? Even though a deleveraging is a difficult situation, handling a difficult situation in the best possible way is beautiful. A lot more beautiful than the debt-fueled, unbalanced excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income, real economic growth is positive, and inflation isn't a problem. It is achieved by having the right balance. The right balance requires a certain mix of cutting spending, reducing debt, transferring wealth, and printing money so that economic and social stability can be maintained. People ask if printing money will raise inflation. It won't if it offsets falling credit. Remember, spending is what matters. A dollar of spending paid for with money has the same effect on price as a dollar of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden. You need to print enough money to get the rate of income growth above the rate of interest. However, printing money could easily be abused because it's so easy to do and people prefer it to the alternatives. The key is to avoid printing too much money and causing unacceptably high inflation the way Germany did during its deleveraging in the 1920s. If policymakers achieve the right balance, a deleveraging isn't so dramatic. Growth is slow, but debt burdens go down. That's a beautiful deleveraging. When incomes begin to rise, borrowers begin to appear more creditworthy. And when borrowers appear more creditworthy, lenders begin to lend money again. Debt burdens finally begin to fall. Able to borrow money, people can spend more. Eventually, the economy begins to grow again, leading to the reflation phase of the long-term debt cycle. Though the deleveraging process can be horrible if handled badly, if handled well, it will eventually fix the problem. It takes roughly a decade or more for debt burdens to fall and economic activity to get back to normal, hence the term lost decade. In closing, of course, the economy is a little bit more complicated than this template suggests. However, laying the short-term debt cycle on top of the long-term debt cycle, and then laying both of them on top of the productivity growth line, gives a reasonably good template for seeing where we've been, where we are now, and where we're probably headed. So, in summary, there are 3 rules of thumb that I'd like you to take away from this. First, don't have debt rise faster than income, because your debt burdens will eventually crush you. Second, don't have income rise faster than productivity, because you'll eventually become uncompetitive. And third, do all that you can to raise your productivity, because in the long run, that's what matters most. This is simple advice for you, and it's simple advice for policymakers. You might be surprised, but most people, including most policymakers, don't pay enough attention to this. This template has worked for me, and I hope it will work for you. Thank you.
Good morning, everybody, and welcome. I'm Eric Schatzker, editor-at-large here at Bloomberg. I have a focus on Wall Street and global investing, and on behalf of Bloomberg, I'm delighted you could join us this morning for the very first in our series of Invest Talks, what surely will be an insightful conversation with Ray Dalio of Bridgewater Associates. Before we get started, a few housekeeping items. It's normal for these kinds of things, although we too are experimenting with virtual conversations. If you experience any issues with your audio or video during our broadcast, just refresh your browser and that should take care of everything. You're going to be able to submit some questions, and I encourage you to engage. We'll be fielding these questions throughout the interview, and while I won't be able to get to all of you, I most certainly will do my best. To submit a question, please type it into the Q&A box below the slide window and then click the submit button. One additional thing, when you do submit a question, please also include your geographic location, whether it's New York, London, Singapore, Dallas, it doesn't matter. Just throw it in there. I'm not going to name you, but I'd love to know where you're watching from. I'm also going to be polling you a few times over the course of this event. You're going to see the polling questions pop up on your screen as we're talking. Please take a moment to register your responses. We are, of course, on Twitter at #BloombergInvest, so please do engage with us there as well. With that, let's welcome Ray Dalio, everybody. He is the founder of Bridgewater Associates. He's a deep thinker. He's the author of the best-selling book, Principles. Ray, welcome. Great to see you. Thank you for joining us.
Great to be here. Thank you for having me.
We're going to kick things off with one of those polls that I mentioned. Ray, this is a question for our audience, not for you. And here it is, everybody. When do you expect normal, and I'm saying normal in quotation marks, normal business conditions to return in your industry? As you can see here, we've got four responses: third quarter of 2020, fourth quarter of 2020, sometime in 2021, and the latter is later than anybody thinks. So please register those responses, and we'll see when we've heard from enough of you what it all looks like. Ray, I think that's a convenient segue into our conversation, and I'd like to begin by asking you this question, or at least asking this of you. Tell us, if you would, about the work you and your colleagues at Bridgewater have been doing trying to understand this pandemic, and share with us some of the conclusions you've reached about its impact on the economy.
Well, I think you know that I believe basically almost everything has happened before. You know, one of the great things about getting old and reading history is you see these things happen over and over again. So this is an economic downturn. It's caused by the pandemic, and you know, we can even go study pandemics and what they're looking like, which we've now done. We wish we had done that before, but so there's this economic downturn, and the way it works is basically that everybody has a certain amount of income. Every individual, every company, every country has a certain amount of income, a certain amount of expenses, and a certain amount of savings, balance sheet. And so this has been a hit financially to income, and it's been a hit to balance sheets, assets. And then so think of those as holes. There's been a hole in income and a hole in balance sheets. And then there's the capacity of central banks and governments to fill in those holes. So there's a financial world. And then that financial world, governments produce money and credit out of thin air, basically, and they can fill in those holes. And so this is a moment which is very analogous to announcements that have happened in the past. March, President Roosevelt announced that there would be the printing of money and credit, and there would be a severing of the relationship with gold at the time, so that they could print money and credit and create credit and to fill in those holes. And that was the exact bottom of the economy in 1933, March of 1933, the exact bottom of the markets, the exact bottom of the economy. Similar things have happened throughout history. We can remember that when 2008 financial crisis, the bottom occurred when the federal government, Congress, and the president created a program to save the banks and to fill in that hole with money and credit, but it's also produced by the Federal Reserve to go buy financial transactions and make those purchases. And that created that bottom because they're filling in the holes. And you could take that when Mario Draghi said he'll do whatever he takes, and then the European Central Bank produced money and credit and filled in the holes. And so the issue is really at those moments, there are the filling in the holes. And so there are two dimensions to that. You can't raise production. You can't raise real wealth by producing money and credit. You could just fill in the debt holes and that process. So we're now in a process of those holes being filled in, and it's very important to look at what holes exist and what they'll be filled in with. And what I mean by that is Americans have holes in different ways. Different Americans will have it. And what will be produced, we're very lucky because we have the world's central bank. So think about it this way: 70% of the world's transactions and savings and most everything is in dollars. And so they buy, they sell, and they save mostly in dollars. And because the Federal Reserve produces that money and credit, it will target it at Americans, and they'll work out exactly what holes will fill in and so on. But we're, in a sense, the world's money, the world's credit is that which is produced by our central bank. But that money and credit really won't go much farther beyond those Americans. and we'll need to talk about what that means for Americans. But it won't go much farther. And then there's a European central bank, which is not nearly as powerful. So there's all of that going
And
on. I'm probably going on too long, but it's filling in the holes.
I was just
and
going to
there will
say,
be a big. There'll be as to who.
before we get
So
into deeper into those holes and deeper into the programs that the Federal Reserve and the government have undertaken to try to fill them in, can you give us a sense, Ray, of two things? First of all, how big is the hole? And how big a hole are we talking about? How long is that hole going to last? Just to give you an idea of what the audience thinks, our viewers don't think they're going to be back, that their businesses are going to be back to normal conditions until sometime in 2021, which is probably about a year from now. So give us a sense of how long you think it's going to take and how big a hole we're going to have to fill.
Well, the holes to incomes in the United States, we estimate somewhere in the vicinity of $5 trillion, and the holes in the world economy is probably somewhere in the vicinity of $20 trillion. And we look at particularly who has what holes, and then how they'll be filled. So the economy as a result of this, so the real economy, which is goods, services, production, and all of that, in the world over the next year, will probably have a fall of maybe 4 or 5%, which is a bigger fall. This is a bigger event than the 2008 financial crisis, and it's most comparable to the 1930 to 45 period of time in terms of, the size of the hole, the unemployment rates, and those types of impact. And then we'll adapt. One of the great things about the greatest force is in humanity and the greatest force in productivity is the capacity of humans to adapt and change the way they're doing things. And we're doing that right now. And so I'm pretty confident that the inventiveness, the adaptation will bring us to a new way of operating. And let's say if you take that decline, that'll be a peak to the trough decline of somewhere in that magnitude. That will get past that, but it'll be a total new world order. The world won't resemble the world that we're used to. It's going to change in various ways. So it's a big hole. It's not a unsustainable hole because the capacity of producing money and credit is unlimited. It means that we have to look at what is the value of money and credit. Okay, that new world. What is the value of money and credit? What is a storehold of wealth? Okay, you just can't produce it without it having its effect on its value. And so while we talk about production, we'll adapt and we'll get past it. But how wealth will change will be very, very big and different.
I'm going to come back to that in just a moment. And I keep saying I'm going to come back to the things you're mentioning, but I promise I will, Ray. In your opinion, is what we've seen thus far in the way of fiscal stimulus from the federal government and monetary stimulus from the Federal Reserve appropriate? Are both of those organs of the U.S. government, if you will, doing what they should be doing? And if they're not doing quite enough yet, what else should they be doing?
Yes, in my reaction, there's no choice. It's like in the 2008 financial crisis, you're faced with a choice. Do you want those banks to exist in the future, or do you want to get rid of those banks? And they may have gone broke, and they may not have had enough savings, and they may have done even things that they should bear the consequences of. But you want to save the banks. And so this is a crisis that's similar, except it goes way beyond the banks. So when you start to think, who do you want to save? You have to think about, do you provide them with income, and how much do you deal with their balance sheet? And if you don't do that, the consequences are enormous. So the reaction needed to be of the sort. We have to think about the consequences, though, of producing all that money and credit. Where does it come from and what does it mean? We'll turn to that in a minute.
So,
but it's just like the
no,
Great Depression. You needed to do that, and you will need to do more. And we will argue over what we should do and who gets what. And that'll be our big discussion. But yes, there has to be more money and credit, and you have to operate in a way where you save important things, and that you only impose a certain amount of suffering on people that they can bear. Otherwise, you'll have a revolution, and you won't have productivity.
Ray, can we talk about some of those consequences? I think that's a critical part of this conversation. When you say the word consequences, are you thinking about economic consequences like inflation, for example, a product perhaps of all the liquidity that's being generated by the government? Are you thinking about the impact that it has on the treasury bond market? Are you thinking about the impact that it has maybe on the foreign exchange market? Are you thinking about those things? Or are you thinking more broadly? Tell me.
Of course, it's my responsibility to think about all of those things. And that's my passion since I was a kid. I'm thinking about all those things. And then you also have to bring in the elements of wealth gaps and politics. The world does not operate just without consideration to how wealth is distributed. So I'm thinking, for example, that when we look ahead, the world is going to be very different. Like when we think about how you'll pay for it. Will there be a reversal of the corporate tax cut, for example? The paradigm that we were in since about 2008 until it ended with the downturn was one in which just mechanistically certain things happened that supported markets, and they included things that probably are not repeatable. For example, when you had a corporate tax cut, the decline in corporate tax rates benefited stocks. When you had interest rates go down, the effect of lowering that interest rate caused all asset prices to rise because they all compete. And so that causes a price earnings expansion, but we won't have in the future interest rates go down in the same way. You had expansion in profits and wealth assets prices going up for the purchase of those, and that benefited those with assets more than those without assets, and that created a wider wealth gap. So you had low levels of interest rates cause corporations to borrow and to buy back stocks and to buy other corporations because the returns on equities were greater than the cost of funding, and that supported prices, and that created a certain cash flow. You're not going to have that. So as we come into the new paradigm, we have to realize that even how is capitalism? How will it mechanically work? What does it mean for redistributions of wealth? All of those questions are part of the same series of questions you asked. So when I think about foreign exchange, when I think about each of the markets, I have to look at it in that holistic way to figure that out. And then I think about that globally. You just can't think about it as one thing. The United States' conditions are different from Europe's, and a difference from China, and different from other countries. And those differences are important. So I have to think about all that, yes.
Now, I was just going to say, could you give us a sense? So you've established some really valuable context, but I want to try and get a better sense of how you think it's going to play out. So things are not going to be the same. What is going to happen with inflation? In the period after the financial crisis, we saw this monetary levitation. We saw asset prices rise. As you pointed out, we saw a widening of the wealth gap, if you will, the rich getting richer. We did see the buybacks that you talked about, the amount of leverage that was built into the corporate economy. How will that be different? Are we going to have more inflation? Will asset prices rise the way they did before? To the point that you just made a moment ago, will the the Fed in its asset purchase program be able to manage interest rates and yields, more importantly, market yields, the way that it's been able to up until recently?
Well, you gave me a bunch of questions there, so I'll take them bit by bit. Let's start with the inflation component. There's inflation in goods and services, and then there's the value of money and inflation in certain assets. I think the period that we're going through right now is most analogous to the 1930 to 1945 period in many, many, many ways. And so in that period, what you had is deflationary pressures, much the same way as we have deflationary. I mean, think about is the supply demand of goods and services such that it's tight? And well, in other words, we're short of the goods and services, and so prices are high. And that's one type of supply demand inflation. Then there's monetary inflation. And so like in the 1930s period, when you had deflation of goods and services, and you had inflation because of financial assets and other things because they produced it. And so you saw a series of currency declines. So you saw one country after another devalue its currency in relationship to other countries' currencies and in relationship to gold, which was then considered the money. And so there were those devaluations. Very similar. Another period of time that seems very similar to me is the 1980 to 1990 period, because what happened then is the world had a lot of debt and money was tight. And then what happened is there was a debt crisis, and it differentiated some countries from other countries. So the emerging countries that owed a lot of debt and also didn't have the best benefit of the money that was coming out of the Federal Reserve had a crisis from 1980 to 1991 when they put the Brady bonds in. But at the same time, the United States was going through a reflation period in which assets reflated, but inflation rates fell globally. So it's important to distinguish what we mean by inflation. This is not a supply-demand kind of global supply-demand. We're going to be short of things, we're going to bid up its price kind of inflation. We have to deal with the monetary inflation. And I think in the early stages of this, you're going to see it reflected in asset prices. So you see it reflected to some extent in gold and to some extent into stocks and other things. I can get into what I think will be the sort of the beneficiaries of that. It'll be a different kind of world. It'll be difficult to, it'll be a very selective world as to what will do well. But pay attention to the value of money. What is a storehold of wealth? No, don't just look at goods and services, because I think when we look at an economy the way we normally do, we just think it's all a function of goods, services, stocks and bonds and so on. And we may not pay enough attention to the value of money. I think we'll be in an environment where that'll be a very important issue.
Ray, I'm just going to take this opportunity to ask the second polling question of our audience. Let's bring it up, and here it is. What quarter will the U.S. economy return to positive growth? Will it be the third quarter of 2020, the fourth quarter of 2020, sometime in 2021, or once again later than anybody thinks? I'm going to give the audience time to think about that for a moment and to register their responses. Ray, I'm going to take this opportunity as well to weave in a question from our live audience. I can't tell you where it's coming from, but it seems relevant given what you were just saying. Is it surprising for you, Ray, to see global equity markets enter what amounts to a new bull market while we're still in the middle of one of the worst health, economic, and financial crises in modern history?
No, not at all. I mean, just like you can go back to the dates of announced reflations. You have a hole. The economy follows. This is the important thing, even when you're asking the question of others, when will it fill in? you have to understand the financial part of it, what it means from incomes and balance sheets. And so what I'm saying is, let me give, I can give you the dates. So it was the date that the bottom, when the Federal Reserve and the Treasury in 2008 announced its program to produce enough money and credit to buy financial assets, that we entered the new paradigm. It was the date that Mario
I'm going to interrupt
Draghi.
you for just a moment. Uh, I'm interrupting you, Ray, just to make one point that I think people are trying to wrestle with right now as they listen to your answers. You're absolutely right that the Fed and the government, for that matter, at least in this country and then elsewhere in Europe, took action in 2008, and clearly the federal government took action and the Fed took action back during the Great Depression. But there's often a lag between the moment they fire the bazooka and the moment that we, so to speak, hit bottom. The bazooka has been fired a number of times over the past few weeks. We don't know whether we've seen the bottom, whether it's the economic bottom, probably not yet, or the financial market bottom. How do you think about that?
I think you're not adequately distinguishing economic activity and stock prices and financial market considerations. I learned this early in life. It was so funny when I was a kid. I was, invested as a kid, and I would see the economy get stronger and stronger and stronger, and I would see the markets go down, down, down. And then I would see the economy get weaker and weaker and weaker, and then I would see them go up, 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 based on what the amount of money and credit is. So it goes, when it gets stronger and stronger, and let's say money becomes tighter and tighter, and central banks become tighter and tighter, that has an effect on the present value of all cash flows and so on, and that's more important. And so the real economy lags the financial economy. So if we're looking at that, we first have to start off with the financial economy, and then we have to say, where does the money and credit flow? And you have to follow those flows. I mean, down at a detail level. So then that's what we try to do. Okay, so money and credit is going to buy they'll buy, what do they buy? Okay, they will buy first investment grade, starts with Treasury, then they buy investment grade, then they buy junk bonds. Okay, what is their objective? Who is going to get the money and credit? What will that mean for the cost of funds? And then you have to follow that money and credit through. I think, just to answer your question, I'm saying it's a money and credit question. At the same time, I can't tell you how much this, I can give you my thoughts about what will happen in terms of it passing through. If I get down to the granular, I think that what will happen is it'll be a big shift in wealth. It'll be a big shift in where things go. And, so when I look at that, I think it's a mistake to look at the economy as a whole. Like, everybody's saying the economy as a whole. There's this economy and it goes up and down based on what they do. But it's not going to be like that. It's going to be more like this, that they're going to change the nature of that mix in a very important way. And that mix is going to change. So while we see, let's say, a 3 or 4 or 5% decline, and then we think about what are our impediments to bring economic activity up, we'll get past those impediments and we'll bring economic activity up, okay? But the balance sheet damage, the income damage, and who is going to get what in that new economy are the most important things. So the flow of
Ray,
money, let me give you an example. The 1971 move by President Nixon, okay, to devalue the dollar and print money, did not help the stock market much. Stock market did not perform well.
No.
Gold, a lot went into gold. A lot went into inflation hedge assets. It created an era. That move in August 15th, 1971 created the 70s, okay? And because of the way that money flowed. So when you ask of stocks, I can't tell you how much stocks, I can't tell you what other assets. As we're working that through, I have my theories and I can tell you. But the nature of that is it's a reflation in which the value of money will go down and the value of other things that are of a certain nature, certain types of stocks, certain types of other financial assets in certain places in the world, which we can delve into if you want, will be the big beneficiaries. And the world order will change in an important way based on who those beneficiaries are, just like what happened after post 1971, just like what happened after post 1933 when
So let's do
those
that.
changes.
Let's do that. Share with
Okay.
us your theories. Who are the beneficiaries going to be, and how is that going to be reflected in the things that we see, like prices of assets and prices of goods?
I believe that as we distinguish, we can do that by countries and parts of the world, and we could do that by asset types and so on. I believe that when you look at bonds um, and debt, a bond is a promise to receive currency. So you have, when you're holding a bond, that gives you no interest rate or a negative interest rate, and they're producing a lot of currency, and you're going to receive that. Why would you hold that bond? Okay, and where is that bond, and who owns that bond? Okay, so this period, like the 1930 to 45 period, is a period in which I think you'd be pretty crazy to own bonds. Okay, because what is a debt? A debt in a fiat currency is a promise to receive currency, and isn't it pretty clear they're going to make a lot of currency? So I think that that changes the appeal of bonds. Why in the world would you hold the bonds? And that has a big effect. So when you start to think about how much wealth is in bonds, and where is that wealth going to go? And how's that going to work? And how are they going to control it? You know, I have real thoughts about that. So what is a good storehold of wealth when we're all holding all of these debt assets? And how will that play out? That'll be an important consideration. Another, and that has to do with storehold of wealth. And so when I think of storehold of wealth, I think, what are the stable storehold of wealth in the form of stocks and other kinds of debt? I want those that have strong balance sheets, stable incomes, and so on, so that you're basically having those assets that will perform well in any kind of an environment. And I'll look at them based on how cheap or expensive they are. And when I think of the world, I divide the world into different locations. As I say, I think that this picture is very much like the 1980 to 90 period, when we're flooding it with financial assets, with money and credit, but they're not getting to a number of emerging countries. So when I look at the distribution of wealth in terms of their balance sheets, like every individual, I look at what is their income, what is their expenses, and what is their savings. And when we go through that exercise, then it changes. I don't want to be in places that don't have good ones. And then I look at civil behavior. How are people with each other? Is there going to be a fight? And will that fight, will people be orderly? Will we work it out? And then what will be the changes in tax rules? Taxation. Will corporate taxes come back in certain ways? What will the changes? Because we're not going to deal with that equally. So I'm looking at all of that to create a picture of differentiation. I see a very differentiated world. And when we talk about the economy coming back, I think you have to realize what big changes are that are behind that can't be changed. Let's say, for example, self-sufficiency. I think we're going to produce different things and we'll be self-sufficient. We operated in a world where we were globally connected, and whoever was most efficient would get it, and we would just go get it wherever it was most efficiently produced. That world won't happen again. So you're going to come to a world where you'll originate it, produce it at home, and that you'll start to think about what do you need. And I imagine that we're going to be rebuilding our basics, healthcare systems. How much savings are we going to put into rebuilding some of those basics, like basics of hospital? What's our storage for the next time we have the next epidemic? And then there'll be other things, climate change. This is the act of nature that hit us over the head, the virus. But there's other evolutionary costs that are going to come in the form of climate change and those types of things. All of those things are important to imagine in imagining the new world order, I think.
So, you and I have talked in the past, Ray, about your concerns over populism, your concerns about inequality, your concerns about capitalism, and some of the flaws that you had observed or believed existed in the system that we still have. And now you've raised the question as to whether there's going to be a fight over wealth. Is there going to be a fight over wealth? Let's just talk about it in terms of this country. What is going to happen in that sense? Is there going to be a battle over tax rates and redistribution? Give me a sense of what you have been thinking and what you anticipate.
Well, again, I'm just a mechanic who tries to be a practical guy. And so when I answer these questions, I don't answer them ideologically. I'm just trying to answer them mechanistically. So as far as what I believe and what I've written, I wrote a piece which how and why capitalism needs to be reformed. And I'm a capitalist. So sometimes you get thrown in as just a generalization. Before this, it struck me that if we have a downturn and we don't have much of an effective monetary policy, we're a particularly risky position, and it's fundamentally not good that we don't have that we have such a problem in terms of the outcomes. It mechanistically, for history, when you have people who share a budget or share wealth, and you have a large wealth gap. And so when you have a large wealth gap and there's an economic downturn, there's a high risk over fighting over wealth. I mean, that's just history. We see it happen over and over again. So most probably there's a question of whether we'll do that well or whether we won't do that well. And I can give historical examples of doing it well and not doing it well, but mostly it's a risky thing that people don't do well. And then in addition, it struck me that the system is not producing the desired outcomes in totality. Because what is the desired outcome? When I was growing up, we created a new world order in 1945. 1945, end of World War. 1945, we created a new dollar-based monetary system. 1945, we began a new world order, and we had the United Nations in New York, and we had the World Bank and the IMF in Washington because it was the American enterprise. And then we had 80% of the world's gold, and we began a process. Now we're heavily in debt, and we are at those kinds of limits. And so how are we going to restructure that world order? So when I look at it, I think in terms of your answer, it depends very much on how we are together. And will we bring the country together? Like the togetherness and being behind a common mission. And what is that common mission? I believe, what is the American dream? Do we know what the American dream is? Or do we each have our individual dreams, like I want to get richer and I want to do something else? And so to me, when I was growing up, the American dream meant something like equal opportunity. I was very lucky to be raised by two parents. My dad was a jazz musician, a modest income, but I was able to go to two parents who loved me, and then I was able to go to a public school. and I got a good public education, and then I was able to go into a world of equal opportunity. And it's those kinds of fundamental things. So we'll need an American dream. We'll need to do it together, and we need to do it harmoniously with those who are competitors in the world like China, if we're going to do this well. And so I think we're at a juncture of deciding, we're in a fork in a road that you will find out in fairly quickly in the next year or two about whether we're going to do this in a harmonious, bipartisan way that we can get through our disagreement or not. And everything depends on that. There's enough wealth in the world and enough opportunity, and still the inventiveness. So what we have to do, it's an engineering exercise. What we have to do is engineer intelligently how to increase the size of the pie. So productivity increases and you increase the size of the pie, and then also divide it well. So we have not only divide the wealth well, but divide the productivity opportunities well. So like investing in education is a great thing. But in any case, yes, how we are going to be with each other when we're creating this new world order is going to be the most important thing.
Ray, I'd like to turn our attention to some of the questions from the audience. Many of them are very similar, which gives you a very clear sense that there are a number of specific things on the minds of people who are out there, and more importantly, the people who are listening to you right now. And I'm going to try and summarize these questions because you know, a number of them dance around the same issue. Some critics say that this is specifically about the Fed programs, Ray. Some critics say it's wrong for the Fed to be in the market buying corporate bonds, buying investment grade bonds and buying junk bonds, as opposed to what they used to do, which was treasuries and agencies, because it's picking winners and losers in the real economy. What do you think?
I think everything is a matter of weighing the pros and the cons. And what happens over a long period of time is that whoever steps into the job inherits that which happened before them. And then they deal with that thing in the best possible way. And over a long period of time, that's bad. Because let's say a government official, you become a governor of a state, and what happens is there's an incentive to spend money and borrow money, because at that time, if you borrow money and spend money, people look at how much you're spending, and you can produce a prosperity on borrowed money, and then you leave your term, and then the person next inherits what they have. And so when you're head of the Federal Reserve and you step into the existing job, you have an overly indebted economy that and you have a situation where if you just bought government bonds in the traditional way, which it is in of itself a problem in a sense, and you just bought that, then you have to allow the other parts of the economy to go broke. And then when thinking about that, you have to then say, what do you do with that? And you have to do it quick, and you have to do it imprecisely. And so the choice that you face is that those companies which were investment grade, all of a sudden, because of the deteriorations in their incomes and their balance sheets, have become junk. And so all of them, a lot of, good quality at one level, considered good quality, becomes junk. And so do you say, oh, I'm not going to provide that money to those? It's just a choice. You have that choice, okay? And you have to think about the consequences of the choice. So yes, it's correct that history has shown that central banks have bought stocks. Central banks have done anything. They will do practically anything and buy practically anything in order to save the system. So you ask what's systemically important, and they'll probably buy it. And therefore you won't have a regular market. And then you as an investor get to make the choice of what do you own. You have that freedom, So what do you own? What are you going to own? You have that freedom.
Ray, here's a question for you about the way you think about the company you founded, because it's a question that pretty much everybody who has any business anywhere in the world is thinking about. I want to know how you're wrestling with the debate over reopening the economy. How will you decide when employees come back to Bridgewater? And what impact is working from home having on uh, a culture like yours, right? A unique company culture, a culture of radical transparency. How are you wrestling with those questions, and how do you think it'll look in the months and even years ahead?
Well, we've been, I don't know, lucky or whatever it is. What we've done years and years ago was to assume that for one reason or another, it could be a hurricane knocks everything out, or it could be any reason, that we would have to be able to operate digitally and so on. And we've done that. We've operated this way, and made it in our normal practices to be able to operate this way. And so when there was the beginning of the virus, I mean, it pretty much, we knew what it would look like. We studied it in the past because it happening in China then also gave us a good sense, and we studied what it was like. And then, so we quickly went operating in this way. And it's some differences in it, but the way we're operating is fine. It's good. And like human evolution, it's all a matter of knowing how to adapt. And there'll be new inventions, and humanity, it'll be, Zoom is very popular, and now online education will be very popular, and it'll prove, and I'm sure man will adapt. And so when we look about, let's say, the coming back, we're going to deal with the health case very seriously. There's a lot of silent transmission, and we're going to be very conservative in terms of how we're coming back, because this way of operating works fine. And so we'll be conservative in when we're coming back. And we also believe that, studying pandemics, these come in waves. So, this is not like just one wave, like it's going to be gone. It'll be really more a question of human inventiveness in terms of coming up with testing processes. And, vaccines still look quite a way out there, but testing processes and various protocols and changes in protocols. And I'm sure that we'll find good ways of adapting to it, as the world will. And so we'll see, but we'll be conservative in coming back, and the way we're operating is, just fine.
Ray, with that, I want to thank you very much for joining us today. Ladies and gentlemen, Ray Dalio, and thank you to our audience for tuning in. This is the first in a series we call Invest Talks. Delighted to have Ray as our first guest. Folks, we'd also love to have your feedback about this event. An exit survey is going to appear on your screen shortly. You can also find a replay of this conversation with Ray Dalio by following the very same registration link you started with today. Stay tuned for more interviews in this Invest Talk series. You can follow us at Bloomberg Live on Twitter and LinkedIn for updates. Please also be sure to follow our ongoing financial and markets coverage on Twitter. At Business is Bloomberg's handle, and of course on Bloomberg.com. If you haven't already done so, please consider subscribing to Bloomberg at Bloomberg.com/subscriptions. I'm Eric Schatzker here in the open. Thank you all very much for joining us today. We'll see you in the next conversation.